Now, joining me to preview the decision are Bismarck Rewane, the CEO of Financial Derivatives and a member of the Presidential Economic Advisory Council. We also have Nnamdi Nwizu, is a co-managing partner at Comercio Partners, and Abdulrahman Yinusa is a former governing council member at the Chartered Institute of Bankers of Nigeria. Gentlemen, thank you so much, as always, for joining us for this broadcast and for this preview. Bismarck, I always like to start with you. What do you expect? How do you see the market conditions and, of course, the macro situation right now impacting the MPC's decision this time?
More likely than not, 70% probability that there will be no change, and 30% probability that rates at the MPR could actually be brought down. Why do we say this? Because growth at 4.03 in the third quarter is quite encouraging, even though annualized about 3% annualized. Inflation moderating, official inflation moderating for the 7th consecutive or 8th consecutive month. But the reality is that prices in the marketplace are much higher than are reflected in that. And the synthetic basket is much higher than the basket that we are talking about. The other thing is that price of oil, Biden has just released 50 million barrels into the market. So the price of oil has dropped to about $78 a barrel from the high of 86, 87. So are we going to be seeing stable oil prices, lower production? We have maxed out on our debt, so there's not much room. And the most important development is that 18 billion naira of promissory notes have been issued for all the each state government, coming to a total of 648 billion naira. How will this play out in terms of liquidity and pressure on the currency? Because the notes have been issued on yesterday and Friday, and they are being discounted in the market as we speak. So what do all of these things mean to inflation? What do all of these things mean to the exchange rate? And what do all of these things mean to fiscal stability and consolidation?
Right. You make an interesting point about Nigeria potentially maxing out its options with respect to debt. And for a moment, if we can just talk about what that means in terms of perhaps austerity measures being rolled out by the government and what that could mean for the macro situation that could influence what the MPC does going forward.
Basically, what happens is that you have your fiscal profile and you have your external sector. The external sector, there are two sources of revenue for the external sector: the oil markets, which is stabilizing, and the debt markets, where you can issue paper. But if you go and issue paper at the time when US inflation is at 6.2% and the likelihood that there will be an increase in interest rates, you're actually going to increase your debt service burden at a time when this administration is on its way out. So that additional debt at this time may not be the most attractive option. Therefore, you have to do what you can. But we must not forget that the PIA has been signed into law, and therefore, you will now have the incorporated joint ventures, which means that the money that was coming in as cash calls from international parties will not come in anymore, because the joint ventures will have to raise their own additional money. So that brings additional pressure on the exchange rate, but also increases the revenue available to the state and federal government in Naira. So all of this means that the revenue profile will look robust in Naira, but will be threatened by the effective exchange rate weakness, which is almost inevitable.
All right, Abdulrahman, let me go to you and let's just reflect on the state of the banking sector and what the MPC's decisions mean for banks. As you know, the highly controversial cash reserve ratio is one that I know that you are not a big fan of yourself. But let's talk about how that is being implemented, because now we're seeing a little, if I can use the term, creativity in terms of how the central bank is trying to get the banks to lend to the real sector by allowing them to use some of that cash reserve ratio. At least there are conditions around that, but it seems there is some movement there. What do you make of that whole dynamic?
Yeah, thank you, Wale, and listeners. I believe for the central bank, they are caught between the rock and a hard place. Here they are struggling to mop up excess liquidity, and excess liquidity is being pumped into the economy on the fiscal side. If you recall the few comments from Bismarck, he talked about promissory notes that are just being issued to the state government, and they are already being liquidated as we speak, which is just supplying more money into the system. It's like, you put on a tap and then you want to mop the floor. The more you mop the floor, as long as that tap continues to pour water onto the floor, it's going to be a very tough task. In fact, if you recall, the cash reserve ratio is already at 27.5%, which, in my opinion, is already way too high. How do you want people to lend when they are keeping as much as 27.5% in cash reserve, not to mind the liquidity ratio of 30% on the other side? So already you are talking 50 and above. But what we are seeing in the banking industry today is that the effective cash reserve requirement is actually somewhere around 50% average, which is almost twice, what the 27.5 is. So it makes even the 27.5% cash reserve ratio of the CBN academic, because I can hardly point to any bank currently that actually has only 27.5% as cash reserve requirement, and therefore the ability to lend is seriously curtailed. Now, let me look at the other side. You also mentioned the fact that, yes, the CBN has put some rules around lending to the real sector, and they can draw down on those cash reserve requirements. But recall that the most important element in that criteria is the 9% single-digit lending rate. Now, if MPR is actually at 11.5, and you are asking banks to lend to the real sector at 9%, effectively, you are saying that the risk premium has now been turned on its head, is now a risk discount. How can risk in the real sector be 2.5% cheaper than MPR? I don't think that will work. So banks will continue to struggle in this dispensation where cash reserve requirement has become 50% and above. And here, in fact, when you look at the range, for some banks, it's actually up to 100%. I mean, if you take the international banks, for example, they will largely be running at probably close to 100% in terms of cash reserve, which means they cannot actually lend anywhere. Right. So I do not envy the central bank at this point at all. I think there are serious rigidities in the system that is making them to go desperate in terms of mopping up. In my own days in banking, we used to call it stabilization securities. That is effectively what this is. You just look at the market, there's excess money, you just issue an instrument, you pay 0.3 or 0.5%. I don't see how that helps at the end of the day. However, having said that, it is possible to recognize that the improvement in GDP, 4% is a big number. We also know we are coming from a smaller base because of the decline because of COVID. Maybe as they see a bit more of these improvements, they will then be able to ease up a little bit, on that. Of course, BG has already given us the first signal, the first salvo, which is that the U.S. government has gone ahead to release 50 million barrels per day from their strategic reserve, and that will bring rates down. Before all of this, rates were, the price was around $86, $85 per barrel. We were just chatting before this program started. Now we're already below 80. We think they may go as far as 75 before they begin to ease off. Now, if that happens, I think the capacity of the central bank to continue to manage the FX at the current rates will come to question. I think it's a tough year end, I think, for the central bank. And we hope that in the new year, when the refinery from Dangote comes in, and we no longer spend the huge amount that we spend on oil importation, then the CBN can begin to get a bit more market friendly. As for now, 50% average cash reserve requirement is unhealthy and unsustainable.
Right. Well, of course, a lot of hope around the impact of that Dangote refinery on the economy. But Nnamdi, let me come back to you. And earlier, Abdulrahman mentioned the turning on the tap. And can you just assess the outlook for liquidity, especially in the context of these promissory notes that have been discussed earlier? And of course, we expect that many state governments will be liquidating those assets to get some liquidity. Your thoughts on the outlook for liquidity and how that could play out in terms of what the central bank does between now and the end of the year?
Well, from a money market perspective, to look at liquidity for the rest of this year is not so great. We know right now market is maybe about 55 billion long. The challenge you have even in predicting liquidity really is that we have the continuous debits by the central bank, and the figure that they decide to debit can be a bit, I don't know to use the proper word, arbitrary, right, or at the discretion of the central bank. So liquidity projections have become a lot harder to make in the market. However, we expect quite some large inflows going into next year, so not this year, because we have quite a number of maturities and bond coupon payments and all coming in the first quarter of next year. But for this year, we don't expect a lot of liquidity coming into the system. With regards to the promissory notes, I mean, they have not just Naira promissory notes, but we also have dollar promissory notes, which are out there in the markets and being circulated around for people to invest in. The truth about it is that, I mean, deep discounts are normally required because the liquidity of the promissory notes isn't anywhere close to the kind of liquidity you have with the FGN bonds, right? So it's not so easy to sell. I know that there's been a time in the past when the central bank actually helped them discount on those promissory notes, helped the states discount the promissory notes, at least from what we heard, because pricing in the market was a bit too steep for them. So let's assume they're offering to discount at, say, 15-20%. You can imagine how much of the money that they're going to have to forgo, right, in exchange for the liquidity that they get now. So, like I said earlier, liquidity this year not expected to be so great, but we expect to start seeing a lot more liquidity coming in next year.
Right. Thank you for that. So maybe the coast is clear for maybe some easing. Who knows? Okay, let's come back to you, Bismarck. Obviously, the major talking point from the last meeting was the press briefing afterwards and the conversation around the black market. Bookie FX became a major talking point at the time. We've had 2 months to assess some of those moves. What do you make of how the market has played out since then? You're muted, Bismarck. You may need to unmute.
Basically, what has happened essentially is that market structure changed. The market, and of course, the Naira got punished. And then the market structure, the typical cobweb theorem, the Naira starts to appreciate, but also in the higher knee window, the Naira depreciated, so that you are getting some form of convergence. But multiple exchange rate persists, and that's why the whole idea, everything comes back to, we have drawn the SDRs, which was $3.35 billion. We borrowed $4 billion. So we've raised about $7 or $8 billion. Oil prices increased, but production stayed low. So there's kind of functional disequilibrium in the foreign exchange markets. But that, again, inflation is eating part of it. And the whole question of under recovery from NMPC. And so what goes first, subsidy or exchange rate adjustment? But in any case, we are going to have both. And it is in anticipation of the revenue impact of those reforms that the federal government has agreed, and the central bank in particular, to give the states 18 billion naira each, coming to a total of 648 billion naira. If you use a 20% discount factor, the effective amount of liquidity coming to the system is about 520 billion naira, which is 1 month's fact in a bad month. Now, so again, let us not mistake liquidity for income. Liquidity is what you can borrow and what you can use to buy things. But income is what you actually consume or what you can invest. So you debit to take out liquidity, but you do not debit to take away income. The income is what people who vote say that I'm taking my money, I'm going to convert it because I'm afraid of erosion of my currency in the modern day in the market. So essentially, the central bank has been able to clamp down on the demand for foreign exchange, but has been unable to do much about the supply. So what happened, the Naira appreciated all the way to 535 and has dropped all the way to 560, 565 as of today. So what are we seeing? We are seeing the IATA rate of exchange for tickets is now 444. The NAFEX window is trading at about 430, 440. And the I&E window is trading at about 415, but there's not enough supply. So effectively, the blended rate for manufacturers in the market comes something around 530 Naira to a dollar. And that's what is priced into the goods you're seeing on the shelves. And that's why the synthetic basket tells you that prices have increased by about almost 70% between last year and this year, while the official data shows that prices have increased by only 15.99%. And so the reality is that the Central Bank of Nigeria has to deal with inflation variable. They have to deal with the exchange rate weakness that comes because of the weakness of oil price and that we have maxed out in borrowing.
Right.
And finally, they have to deal with a form of stability, monetary stability, so that the economy doesn't go into much difficulty. Don't forget that yesterday Ghana increased the interest rate by 1%. South Africa has increased interest rates. So inflation is not just a Nigerian phenomenon; it is global in the US, in Europe, in China, and so the central bank is able to manage all of these variables. Convergence of the exchange rate is critical, a critical factor, and it was even raised in the Article 4 review of the IMF.
Indeed, the Article 4 review did point that out. But before I go to Nnamdi, a very quick answer to this. Would you say that with what the central bank achieved about 2 months ago and how things have played out, the bleeding in quotes of the Naira is perhaps a thing that we can say the risk has been mitigated significantly? Or do you think that more so now that there is still that risk that oil prices could fall maybe another $5 or so, there is a risk that we could see even more pressure on the Naira? Very quick answer to that.
No, there's going to be more pressure on the Naira because you're borrowing, the oil price, and more than anything else, the extra liquidity that has come into the system because of the promissory notes in anticipation of revenue anticipation bonds or promissory notes that were issued. All of this means extra liquidity, more inflation, and a weaker Naira. But the central bank is going to be using all tools at its disposal to make sure that they keep the reigning prices. That's all.
And Nnamdi, how do we fix the supply problem? I know it's not a quick fix. The central bank will continue to do its best. But what do you think they can add to all that they have done so far that could eventually bring a little more supply, potentially from the foreign portfolio investors?
Well, I think the other thing left really, I want to do another thing. I think there are two major factors. One would be high interest rates, which would definitely attract foreign investors. But we know that comes at a huge cost to the central bank and also the government as a whole, because if the central bank, for instance, starts to increase home rates and push up their cost of liquidity management, then you also have the federal government bond rates start to go up, which means the government has to pay more to borrow. So that's one option, which would bring in more of the portfolio investors. The second option would also be to ease a bit on the market's moral suasion that they're using and allow the market to start trading effectively in a two-way quote market, because till today we still don't have that effective two-way quote FX market that we had, say, some 3-4 years ago, right? So if that can happen, then that gives a lot more confidence to the foreign investors who love to have liquidity, because right now most of them end up queuing at the central bank window to try and get FX. I mean, but the flip side to that is you most certainly have some depreciation of the currency, at least in the short term, before market basically find its level and we start to see a lot more inflows coming in, and we see the now appreciates maybe not too far from where it is currently. But I think those are two things that we can do from the central bank part of things. I mean, the other things more on the fiscal side, things like equivalent security and co, and better investment climates for the FDIs to come in.
Thanks so much for that. Okay, I want to come back to you, Abdulrahman, and let's look at the banks for a moment here and the implications of FX instability. On the balance sheets of banks, I know you used to be a CFO, so you'll appreciate this a lot more. What are the banks dealing with when we see a lot of volatility in the foreign exchange, the exchange rate? And then what can they do to sort of mitigate that risk?
Okay, thank you, Wale. I think the biggest challenge of any institution that deals in foreign currency is the exchange rate risk. And we do know that the best way to manage any exchange rate risk is to make sure there is a coincidence between the currency of the borrowing and the currency of the operation. So if you borrow dollars to run a Nigerian business, then you are already setting yourself up for a very big problem down the line. So what we've done in our own days in the active banking industry is to ensure that we actually ring fence any monies that we actually raise in foreign currency by investing them in foreign currency denominated assets. Now, any bank who has not done that upfront is already in trouble because I can assure you that the exchange rate in terms of projection into the future, we use the purchasing power parity, for example, and you look at the interest rate differential between the US and the Nigerian Naira, for example, and you look at any time frame, pick any time frame, 1 year, 6 months, 10 years, and compare the rates, you already can see that there is going to be a huge revaluation loss on your balance sheet if you do not match your assets and liabilities in foreign currency. Right. So for me, it's the beginning of wisdom. If you take money, we took like $200 million in Eurobond, for example, at some point, and we ensure that all the assets that we put them in are also assets that earn foreign currency, maybe oil sector, and all that. Of course, whatever then happen would then be credit risk, but at least eliminate the exchange rate risk. And between you and me, just to touch briefly on Nnamdi's position, I do not subscribe to foreign direct investment as a fundamental source of supply of FX into an economy like ours. It is that's why it's called hot money. Rewane will remember how $5 or $50 billion, came in I think in 2015 or so, during the Sanusi era. And before you say Jack Robinson, they are moving out to the same thing. And, they just collapse your currency. So to the extent that you want to fundamentally address supply in the economy, let's not look at foreign direct investment or foreign portfolio investment as the source. If it is foreign direct investment, they are welcome, and they are going to be here for a while, and they're going to be here, to at least, generate revenue to remit. But portfolio investment is called hot money for a reason, and it's hot money to the extent that it can evaporate in less than no time. Right. And for me, to the extent that you have a gap, such a significant gap in the exchange rate in the market, it's a big disincentive for any foreign investor. Because technically speaking,
I'm so sorry.